What if I told you that memorizing 30 different candlestick patterns is actually the fastest way to lose money in the markets? What if you only needed to master 3 and read them like a raw human battlefield instead? Let me pull back the curtain on a truth that took me years of expensive mistakes to finally understand. If you want to make it as a trader, you have to stop looking at indicators and start understanding Japanese candlesticks. See, candlesticks aren't just little colored boxes on a screen. They show us the real raw price action of the market. Honestly, they are 1,000 times more effective at forecasting where a market is going than any lagging indicator you can find. In this complete masterclass, I'm going to walk you through exactly how to use these candles to forecast market direction, how to visually read the fierce battle between buyers and sellers, and how to spot great trades so you can actually start pulling consistent money from the markets. And look, if you have absolutely zero experience with charts right now, do not worry. I'm going to guide you all the way from beginner to pro. You don't need to know a single thing to follow along with this story. So, what exactly is a Japanese candlestick? At its simplest, it's just a single building block. When you string hundreds of them together, you get a candlestick chart. We'll get to the charts in just a second, but first, I want us to zoom in on an individual candle so you can see the magic of how it breathes. What a candlestick really tracks is price movement within a specific box of time. If you click on an hourly chart, one single candle tells the story of exactly what happened to the price within that 60-minute window. Every candle is made of 2 parts. You have the solid candle body and then you have the wicks, those thin sticks poking out of the top and bottom. The body represents confirmed price movement. The wicks tell the story of rejected price movement. Think of it this way: if we are looking at an hourly candle, the body tells us that when the hour started, the market opened right here, and when the hour ended, it closed all the way up here. Because the price increased, we call this a bullish candle. But look at the wicks on that same candle. The lower wick tells us that during that hour, the bears actually pushed the price lower for a bit, but the market rejected those cheap prices. The upper wick shows us that the bulls tried to skyrocket the price even higher, but they got pushed back down before the hour officially closed. So, the body is the solid ground the market managed to hold, and the wicks are the territories the market visited but failed to conquer. When you look at a chart, you'll usually see 2 colors, green and red. A green candle is your bullish candle. It means the bulls won the hour and the price went up. A red candle is your bearish candle. It means the bears dominated and the price went down. On a red candle, the market opens near the top, and by the end of the hour, it closes all the way down near the bottom. You can customize these colors to whatever you want, but the plot remains the same. Bullish means a price increase, bearish means a price decrease. Now, why do we even bother using these instead of a simple line chart? Because a line chart only shows you where the price ended. It hides the drama. Candlesticks give us an intimate look into the buying and selling pressure. They show us exactly who is holding the steering wheel. The entire market is just a massive tug of war. If there's more buying than selling, the market moves up. If there's more selling than buying, it moves down. Candlesticks let you watch this battle happen in real time. Depending on how violent the battle is, the candles will change shape. Sometimes you'll see a candle with a massive body and almost no wicks. Other times you'll see a tiny body with giant wicks stretching out on both sides. Both of these shapes tell a completely different story about the psychological state of the market. Take that first candle, a big beautiful green body with tiny wicks. That tells you there was uninterrupted buying taking place. There is a massive distance between where the hour opened and where it closed, meaning the bulls rallied the market with sheer force. Those tiny wicks prove that the sellers put up almost no resistance. If sellers had stepped in, they would have pushed the price back down and left a long upper wick, but they couldn't. The buyers are clearly in total control. When I see a market moving with that kind of pure, uninterrupted momentum, my strategy is simple. I look for opportunities to buy. I'm going to show you some real examples in a minute of how I use this insight to catch incredible trades, and more importantly, how it saves me from taking catastrophic losses. But first, let's look at that second candle, the one with the tiny body and the massive wicks. The open and close prices are sitting practically on top of each other, but the wicks are huge. Those long wicks mean that sellers tried to crush the price from the top, and buyers tried to lift it from the bottom. Unlike our strong momentum candle, this one represents total indecision. It shows an equal level of violence from both sides. They fought like hell for an hour, went up, went down, and ultimately closed right back where they started. No ground was gained. Wicks don't just show indecision, though. They can also signal a massive, sudden reversal. Imagine a candle with a small body at the top and a giant wick hanging down below. At the start of that hour, the sellers were completely in control. violently driving the price into the dirt. But somewhere down there, a massive wall of buying pressure stepped in, completely overwhelmed the shorts, and shoved the price all the way back up to close near the open. That is a beautiful signature of a market reversing in real time. Let's do a quick mental quiz to see if you can read the story. Imagine a red bearish candle. The open is at the top, the close is at the bottom, and there are almost no wicks. What is that telling you? It's telling you there was uninterrupted selling. The bears completely dominated the market from the opening bell to the final second, and the buyers couldn't even mount a minor defense. Now, what if you see a red candle that opened, tried to push way up into a high rally, but then got violently dragged all the way back down to close below the open, leaving a massive upper wick? That shows a brutal shift in control. The buyers tried to show off their power, but they failed completely. The sellers took over the room, shoved them out, and kept control all the way to the close. And finally, what if you see a candle where the open and close are a thin line right in the middle, with huge spikes on the top and bottom? You guessed it, pure indecision, a total stalemate where neither side could hold the crown. Once you master these basics, you can read market momentum like a book. Big solid candles mean clear control. Tiny bodies with long wicks mean a phase of confusion. Giant single wicks mean a sharp reversal of power. So, how do we actually use this to win trades? I use it in two distinct ways. First, I use candle momentum as a shield to avoid taking bad trades. This alone will save you thousands of dollars in avoidable losses. Second, I use it as a trigger to add massive confirmation to my good trades. Let me tell you about two real trades from my own account. One that I took and won, and one that I completely avoided because I listened to what the candles were saying. To keep this simple and focused, we are going to ignore all extra chart indicators and focus purely on the candles. For the first trade, I was looking to take a short position, a sell, from a specific supply zone on my chart. That was my plan. But as I watched the market approach my zone, I noticed a sequence of strong, uninterrupted green candles. They had massive bodies and tiny wicks. Not only was one candle strong, but multiple candles in a row were printing with identical aggressive upward speed. At that exact moment, I knew I couldn't blindly short the market. The buyers were clearly in total control. Selling into that would be like standing in front of a freight train. If I wanted to sell, I had to wait until the crown changed hands from the buyers to the sellers. As soon as the price hit the absolute high of my zone, the market stalled. Those big green candles vanished. Instead, the chart shifted into a messy phase of indecision. Small bodies, wicks poking out of both sides, no clear direction. The buying pressure had completely evaporated. Right after that confusion, the bears made their move. The price tried to push higher, but it kept leaving these massive upper wicks, proving that sellers were stepping in and slamming the door shut. It happened once, twice, 3 times. Then the indecision broke, and the market printed 2 massive solid red candles with almost no lower wicks. The reversal was complete. The sellers had officially taken the wheel. Because I read that transition, I executed a short trade right there, targeted the lows, and walked away with a beautiful profit. After banks cleared that profit, I stayed at my desk looking for a second setup. The market looked heavily bearish, so I thought I could look for a continuation trade to go short again from a zone slightly higher up. My game plan was for the price to pull back up into my line, trigger my entry, and slide lower. But what happened next completely put me off the trade, and this is exactly how you use candles to save your capital. The market dipped, bounced, and then out of nowhere, printed a gargantuan green candle. When that hour opened, there wasn't even a tiny attempt to go lower. There was 0 lower wick. The bulls took control from the absolute first second. It left a small wick at the top, but the body was so massive it completely engulfed the price action of the previous 15 to 20 hours combined. That single hour of buying completely erased nearly a day's worth of selling. I looked at that candle and immediately tore up my plan to short. The sellers were gone. And thank God I listened to that candle, because instead of dropping, the price rocketed right through my zone. If I had taken that trade, it would have been an instant loss. That one candle saved me over $1,000. If buyers are dominating, you do not sell. Period. Now, if you go looking online, you'll find people trying to teach you 20 or 30 different candlestick patterns. They'll tell you to memorize every single one of them. Frankly, I think that's a trap. If you run a pattern recognition script on your charts, you'll realize these shapes appear everywhere and constantly fail. Memorizing dozens of names just clutters your brain and costs you money. You don't need 30, you only need 3 candle patterns: the pin bar, the engulfing, and the doji. Let's talk about the pin bar first. A pin bar has a tiny body at one end and a massive, dramatic wick shooting out of the other. Based on what we discussed about rejections, you already know this represents a sharp reversal. We can use these bars as direct doorways into trades. A bullish pin bar forms when a candle opens, plunges heavily into a low price, but then gets hit by a massive wall of buying that forces the price all the way back up to close right near the open. It proves the sellers tried their best and failed. A bearish pin bar is the exact opposite. It stretches way up into the sky before institutional sellers slam it back down to close near the floor. But here is the golden rule. A pattern is completely useless without context. If you trade a pin bar in the middle of a random messy chart, you will get chewed up. It has to appear at a meaningful area, a key support or resistance line, or what I personally use, supply and demand zones. Imagine the price rallying up into a historical supply zone where I am hunting for a reversal. The market taps the zone and prints a clean bearish pin bar with a long upper wick. Now that pin bar by itself is just an indication, not a confirmation. It's a whisper that the market might turn, but I don't trade on whispers. I wait for what I call the standard confirmation. Standard confirmation is all about tracking the structural shift of the market. If the market has been making higher highs and higher lows, I want to see it break that pattern, drop down to create a clear lower low, and then bounce back up to form a lower high. That lower high is my safe confirmed entry. So, looking back at the chart with my pin bar, I can see the price action internally making a high, a pullback low, and a final spike. I don't sell the pin bar immediately. I wait for the price to drop and break below that previous pullback low. The moment it breaks, it confirms the pin bar was real. I place my entry order at the bottom of the pin bar, tuck my stop loss safely above its high wick, and wait for the market to do a quick retest before it sails down into profit. It's a systematic, stress-free way to trade. The second pattern you must master is the engulfing pattern. This is easily one of my favorites. A bullish engulfing happens when a red candle is completely swallowed, body and all, by a massive green candle right next to it. It tells you that the buyers at this price level have completely overwhelmed the sellers. The beautiful thing about an engulfing candle is that it doesn't just indicate a reversal, it actually confirms it right there on the spot. It is essentially our entire market structure confirmation pattern zipped up into one powerful candle. When a bullish engulfing prints inside a key demand zone, you have two options for your entry. The simplest way is to enter the trade the very second that big engulfing candle closes, placing your stop loss right beneath its low. It's direct and you'll almost never miss a trade. The second way is to be a bit more patient and wait for a minor pullback to test the body of the engulfed candle before jumping in. Your stop goes in the exact same place, but because your entry is lower, your risk is tighter and your reward is much bigger. Let me show you how the math plays out on those two styles using a real trade example where I risked $100. If I had used the first style entering instantly at the close of the engulfing candle, the market would have run straight to my target, yielding a 3.15% return, or $315 in profit. Not bad at all. But by using the second style, waiting for that refined retest entry, I managed to squeeze an extra $100 out of the exact same market movement, walking away with a 4.14% return, or $414. Now the trade-off is that sometimes the market will just rocket away without pulling back, meaning style 2 will cause you to miss some trades. But when you do catch them, they pay significantly more. Finally, our third pattern is the doji, or the indecision candle. Unlike the pin bar or the engulfing, a doji doesn't promise a reversal or a continuation. It simply tells you the market has gone completely flat and is moving sideways in a tight consolidation squeeze. It's a warning flare that a big move is building, and it can break out into a reversal or a continuation of the current trend. To trade a doji reversal, we treat it exactly like a pin bar. If a doji prints inside a heavy supply zone, we don't guess. We wait for the market to break structure to the downside, wait for the retest of that doji range, and then ride the bearish momentum down to our targets. But you can also use a doji for a continuation trade within an existing trend. Imagine the market is in an aggressive downtrend. It's sliding down and then suddenly it pauses and prints a tight doji candle. It's catching its breath. For this setup, I watch the low of that doji box. If the market breaks beneath the doji low, it tells me the downtrend is resuming. I can use the top of the doji as my stop loss, enter on the breakdown, and follow the trend further down. At the end of the day, these are the only three patterns you will ever need to achieve financial freedom: the pin bar, the engulfing, and the doji. They are your keys to reading who owns the market. Don't become obsessed with memorizing rigid textbook shapes. Work dynamically. Look at what the wicks are rejecting. Look at what the bodies are confirming, and always make sure you are trading on the side of the heavy hitters. To help you keep all of this straight while you're analyzing your charts, I've put together a complete candlestick cheat sheet. You can print it out, stick it on your wall, and use it as a daily blueprint. The link is right there in the description below. Master these visuals, protect your capital, and I will see you in the very next video.